Today's sales strategy, equity rescue made easy. Hi everyone, I'm Steve Savant, host of the daily talk show, Let's Get Down to Business.
And I'm Don Prehn, Senior Advisor to InsMark.
Today we're talking about this idea of making an equity rescue and making it easy to understand. Many of our clients are in equity positions in the market. I just want to review, before we get into it, some of the basic issues of why we're showing the difference between an equity position in the market and using indexed universal life. Kind of a tale of two cities. I want you to look at some of the equity account, we call them limitations. You have management fees. Now, whatever the IRA is charging could be his fee. We have the normal fee, the fund fee itself. And remember, keep in mind, most fund fees have the undisclosed statement of additional information. So I just want to bring that up and say those are some of the numbers we have to look at. Then, of course, we're looking at income tax on dividends, income tax on realized short-term gains, capital gains on unrealized long-term gains, and turnover, income tax or capital gain tax. And by the way, your client wants to know in January, why, if I had a loss position in my fund, do I still have to pay capital gains? And just keep that in mind. That's the number one question we get in January. Now, I want to compare that against the haircut on the indexed use. I mean, because think about this. These are not managed funds. These are options that we're buying. And on top of that, there's no credit for a dividend. And we do have mortality charges. And when you're doing comparing it, to be fair, I think sometimes you have to subtract whatever the term cost is if you're investing the difference into the fund, just to kind of get a good balance sheet, equal opportunity to compare side by side. Now, on this case study, I want you to walk us through what this is working about here. We're talking about Tom and Ann Murray. They're both 45. They currently have a valuation in their equity position of $250,000 with $200,000 in cost basis. I'll go to the screen, open this up, and give us an introduction of what we're looking at here.
Yeah, when we talk about equity rescue, they've got the $250,000 in the equity fund, $200,000 of basis, and what we're going to go in the InsMark Wealthy and Wise software, and we're going to ask one of the calculators if we took that $250,000 that's currently in the equity fund and we liquidated it over 5 years. We rescue the money out of that equity fund and put it into a cash value life insurance policy, and we did a 5-pay. What would that look like? And what it does is it generates a $53,000 5-pay premium. After tax? After tax, because the money in the equity account was after tax. So we liquidated over 5 years, net of any tax on interest over that period. And so here's your $53,000 premium. This shows we're going to go out 20 years and we're going to start taking loans out of the policy. Here's your cash flow. Here's your cash values out to age or year 50. And here's your death benefit. So that's a basic graphic showing that if we took the money out and did a 5-pay cash value life insurance policy, here's what it would look like. So
what we've done with a 5-pay is we're trying to stage it into the index universal life bonds. We've paid any taxes due on this while we're doing this. And now what we've done is we've actually generated a lot more in total accumulation. In fact, not only that, but the death benefit, which the fund didn't have.
Well, actually, the fund does not have death benefit, clearly, the equity fund. What this is just showing is what would the policy values look like, the death benefits, the cash values, and what kind of income. The next graphic we're going to look at is going to be a comparison. And so here's the really interesting thing. This is the net worth of the equity fund against the net worth of the cash value policy. And what you'll see is that in the first 10, 15, 20 years, they're pretty close. The life insurance policy is a little bit less because of the charges in the early years. But what's interesting is very quickly after the 10th year, the cash value policy's value starts to pull away from the equity fund. And then we start taking income from the equity fund, the same amount of money from the equity fund or the cash value policy. The equity fund gets driven right into the dirt. And look at the net worth of the cash value policy. It keeps growing. If we can make this a little bit smaller, I want to show what happens out at the end. There we go. You can see, look at this cash value policy's net worth value, and look at your equity fund. When we start taking income, it drives down to only $50,000. The cash value policy's net worth is $1,000,007.
Now that's dramatic.
Okay, so we just saw how much more net worth you have with the cash value policy versus the equity fund. Now let's look at wealth to heirs. As you can see, on this graph, again produced by Wealthy and Wise, InsMark's Wealthy and Wise software, the wealth to heirs with the cash value policy ends up at $1,008,000 by age 95. The wealth to heirs with the equity fund, after we take the income out of it, only $50,000. So there's just no comparison between which plan is better for the client over time.
Okay, so what we've done, if I understand you correct, Don, is we've taken a basic equity position in the market and we've repositioned it using Index Universal Life and see dramatic impact not only on death benefit, not only on growth, but money to heirs. Today's sales idea is brought to you by Ash Brokerage, the practice enhancement company.
And by InsMark, the most widely used software when it comes to strategies and presentations using cash value life insurance.